Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about WASION Holdings Limited annual report. WASION Holdings Limited offers a diverse range of businesses and services across various sectors. At the core of its operations are energy metering and efficiency management solutions for the energy supply industry. The company's product portfolio includes smart meters, power quality monitoring devices, measurement automation systems, and application systems. In addition to these products, WASION Holdings also provides network interface modules, data concentrator units, communication modules, RF gateways, and system software solutions that enable utilities to manage their operations efficiently. The company's services include energy data mining, meter data reading, prepayment vending management, and smart network management systems. WASION Holdings' product offerings extend beyond energy efficiency solutions to include renewable energy storage application products and high-voltage electrical equipment such as automatic reclosers, fault detectors, and circuit breakers. The company also develops and manufactures data collection terminals and trades in electronic components. Geographically, WASION Holdings operates in several regions including the People's Republic of China, Africa, the United States, Europe, and rest of Asia. With a presence in multiple markets, the company is well positioned to cater to the diverse needs of its customers across various industries. WASION Holdings' limited market capitalization of $28 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that WASION Holdings Limited holds a significant advantage in their industry. WASION Holdings Limited trades at a higher price-to-earnings ratio of 23 times, and a higher price-to-book ratio of 3.96 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 53% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company in the energy sector are multifaceted and varied. On one hand, revenue from smart grid solutions has seen a significant increase of 14%, while integrated energy efficiency solutions have contributed to a 9% growth. Digital energy services have also experienced a substantial boost of 23%. National policies promoting new energy-generated electricity integration have played a crucial role in driving demand for smart power meters with time-of-use metering and real-time pricing response. Furthermore, the market demand for green power identification and statistical functions has increased, driven by computing power electricity synergy and virtual power plants. Energy storage capacity electricity price compensation policies have also contributed to revenue growth. The company's rapid deployment of digital power supply products in the domestic telecommunications operator market has been another significant driver of revenue growth. In addition, the global power grid investment is expected to reach US $1.7 trillion by 2026, and the company's overseas demand for smart meters remains positive. New product development and business expansion have also contributed to revenue growth. The company's stable development of its smart grid business, deepening cooperation with industrial customers, and accelerated demand for data center construction driven by AI are all significant drivers of revenue growth. On the other hand, the primary drivers of revenue decline are largely macroeconomic in nature. Macroeconomic policy adjustments in the new energy sector have led to a 5% YoY decrease in revenue. The shift from mandatory storage to market-driven plus capacity compensation policy has potentially reduced government-mandated sales, while the removal of mandatory storage for new energy has disrupted traditional revenue streams. Intensified competition in the domestic market and the slow pace of new market development in the European market due to customer delivery schedules have also contributed to revenue decline. Overall, the company's revenue growth is driven by a combination of technological innovation, digital smart city initiatives, new energy businesses, and intellectual property rights, while its revenue decline is largely influenced by macroeconomic policy adjustments and intensified competition. Net income experienced a significant surge, with a 50% year-over-year (YoY) increase as reported on page 21, and another 50% increase mentioned on page 43. This substantial growth in net income is a testament to the company's financial health. The profit margins also underwent notable changes. The gross profit margin saw an increase from 34.8% to 35.7%, as stated on page 21, indicating a slight but positive shift. Furthermore, it increased by plus 0.4% YoY and plus 0.9%, as reported on pages 42 and 43, respectively. The primary driver behind these improvements is attributed to the company's strategic efforts in cost reduction and technological innovation through research and development (R&D) initiatives. By implementing effective cost reduction measures and investing in R&D, the company has been able to optimize its operations and enhance its bottom line. The company's debt level and interest expenses have undergone significant changes over the past year. While total borrowings decreased by a net amount of RM 100,000, 300 from RM 1,000, 587.2 million to RM 1,000, 486.9 million, current liabilities increased by RM 743,000, 539 from RM 7 million, 351,000, 853 to RM 8 million, 95,392. This indicates that the company's debt level has not decreased as much as it seems, but rather shifted towards more current liabilities. In terms of interest expenses, there is a notable decrease from RM 100 and 25.53 million in 2024 to RM 100 and 6.6 million in 2025. However, this reduction may be attributed to the change in interest rates for bank borrowings, which decreased from 1% to 12.12% per annum in 2024 to 1.23% to 9.4% per annum in 2025. This shift in interest rates could have contributed to the decrease in interest expenses. The company's interest-bearing bank borrowings also show mixed results, with an increase of RM 114,608 from RM 971,473 to RM 1,086,081, and a decrease of RM 215,903 from RM 1,615,723 to RM 1,400,820. Overall, while the company's debt level has not decreased significantly, its interest expenses have decreased due to lower interest rates. The performance of various segments and regions in the industry has been mixed, with some areas showing significant growth while others have struggled. Segments such as integrated energy solutions, digital smart grid efficiency services, and smart grid solutions have performed well, with revenue growth ranging from 16% to 50% year-over-year. The independent storage segment has also seen success, with a 65% market share in 2025. On the other hand, domestic power grid investment and domestic new energy sector have slowed down and decreased by 5% respectively. In terms of regions, China has been a standout performer, with notable progress in signing delivery contracts for smart meters and significant revenue growth. The Americas, Asia excluding China, North America, Latin America, specifically Brazil, European market and Africa have also shown well-performing results, with growth rates ranging from 17% to robust power demand. However, the domestic market has struggled, with poor performance in the domestic new energy sector. Overall, while some areas of the industry are thriving, others continue to face challenges. Management is optimistic about the company's outlook, citing government policies that will support power grid upgrades and equipment renewals. This favorable environment is expected to benefit the company significantly. In terms of strategy, management plans to focus on key areas such as infrastructure, new energy, and industrial projects. The goal is to consolidate core markets while expanding cooperation with power plants and imported meter distributors. This approach aims to position the company for long-term success and growth. Looking ahead, management envisions a future where the company becomes a leading global provider of comprehensive solutions for smart and digital energy. To achieve this vision, the company will accelerate its overseas expansion by leveraging its expertise in power IoT and aligning with global trends such as AMI2 and new energy electrification. Internationalization and technological innovation are identified as core growth drivers, underscoring management's commitment to staying ahead of the curve and capitalizing on emerging opportunities. There is no significant activity to report on acquisitions and divestitures. The company has not made any notable purchases or sales of assets, businesses, or subsidiaries during the period under review. This indicates a stable and conservative approach to business expansion and restructuring. As such, there are no major changes in the company's portfolio or operations resulting from acquisitions or divestitures. The company has a history of paying dividends to its shareholders. According to the provided information, the company paid out HK 38 cents per ordinary share in 2024 and has proposed an even higher dividend of HK 48 cents for 2025. Furthermore, a final dividend of HK $0.48 per share is also proposed for 2026, with a payment date set for June 11th of that year. This demonstrates the company's commitment to rewarding its shareholders through regular dividend payments. That concludes the financial summary for WASION Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.